Hi, Lori.
Good morning. Afternoon, I guess. How are you?
Give me 1 minute.
Take your time.
Our normal quorum today, huh? All right. Subject is chapter 11. Chapter 11, and you went through chapter 10, huh? I hope you got familiar with the sales discounts
Yep.
and the sales returns. Well, we got the same thing going here with purchases. So what we used to call a sales return, we're going to call a purchase return. And there's a few other bells and whistles, and let's see what we can dig up here.
Okay.
You can see the slide now?
Yep.
Ooh. There we go. You don't mind if I get comfortable here?
Please do. I am.
There we go. Ha. All right. Let's see what we have here, huh? Accounting for purchases and cash payments, okay? Talking about merchandise purchases. In this chapter, we are buying merchandise, meaning we're buying something and reselling it. We're a store. We're like Nordstrom's, okay? Purchases return to purchase acquired for resale. That's what merchandise is. It's for resale to the end user. And then they talk about procedures and documents. And what's this other bullet? Can be made on account or for cash. We're pretty much talking on account. And these are forms that companies, at least they used them in my day. I don't know if they still do these things, a purchase requisition, purchase order, receiving report, and the invoice. But let's know the definitions of these. These are worth a couple of points on the test. Purchase requisition, that starts the process. I work for you, Lori, right? And you have the authority to order equipment and I don't. So I fill out a purchase requisition, and all it is, it's a form to request the purchase, and just about anybody can fill one out. So I give it to you and I say, boss, I need a new computer. And can you help me out here? And you would approve it. You would approve it. And then you'd probably turn it over to the purchasing department. They're the experts in buying the equipment at the best price, the best quality for the best price. The purchase requisition is not a contract or anything. It's just a request for to buy something. Nowadays, purchase requisition could be an email. You know, could be, you don't really need a super form, but this is what it used to look like, huh? You familiar with purchase requisitions, Lori?
I am. I don't use them because I am every department of my business, but yeah, I know.
There you go. Well, here, this is Sunflower Cycle, and somebody is asking for something. Emily wants to buy a double tap lever, and she gets it approved by Dan Hughes, and then it goes to CMT and Geary in purchasing. Purchase order. Now, once it's approved, the purchase order, and you use purchase orders probably in your business, no, Lori? Purchase order. Well, that's the contract now, huh? It's a written order to buy goods from a specific vendor. The purchasing department reviews, approves the requisition, and prepares the order. And they talk about the old-fashioned movement of paper around. But yeah, you obviously you send one to the vendor. That's how you order what you want to buy. And then the accounting department probably gets one, and the purchasing, probably the warehouse downstairs too, the receiving area. Copies may also may be sent to the receiving area and to the department. Purchase order. Now we got something very specific. Still no accounting entries though, huh? No accounting entries at this point. And there's the purchase order. My goodness, it looks exactly like the purchase requisition, huh? Except this one is signed by Dan Hughes, the guy who had the authority. He was the one who approved this purchase in the first place. The receiving report prepared in the shipping and shipping warehouse area. The goods arrive, you count them, and there should be some kind of packing slip with it, and you write out your receiving report. And what you're doing is you're indicating that what has been received, and it can be a separate form or it can be created from the vendor's purchase invoice, okay? So the purchase requisition and the purchase order and the receiving report are all probably going to come up to accounting eventually. And then the invoice. This is the bill we're going to get. This is prepared by the seller as a bill for the merchandise shipped. Seller calls it a sales invoice, buyer calls it a purchase invoice. So again, you take the invoice, the purchase order, perhaps the requisition, certainly the receiving report, and you staple them all together until you're ready to pay the bill, and then you're probably going to staple a copy of the check on top of that. Purchase invoice, that's what we're talking about in this chapter. And there's a due diligence that needs to be done. There, you get a bill. You just don't pay the bill without checking it. And you're going to look to see if it was requisition, what's the purchase order, is the receiving report in agreement? And that's an internal control. Here is the invoice. They spent $760. Cash discounts. Cash discount. We called it a sales discount in the other prior chapter, right?
Mhm.
This time, let's call it a purchase discount or a cash discount. I guess purchase discount would make it clear. Sales discount or purchase discount. So trade discounts. Let's talk about trade discounts. These are not anything to be recorded financially, Lori. Trade discounts, and perhaps your business even does this, I don't know. Trade discount is basic discounts that you see in the catalog, perhaps of a company. It'll say that the list price is $100 and you order it, you get 30% off immediately. Well, that's not an accounting transaction. And in fact, they're telling you they're selling it to you for $70. It's offered by the manufacturer wholesale. It's a reduction from the list or catalog price to certain customers. Trade discounts are a reduction in the price. They don't go into the accounts of either the buyer or the seller. You record it at the net. You're not going to record it at $100, then pretend you got a 30% discount. That's not what we're talking about here.
Mhm.
If there is both a cash and a trade discount, the cash discount is obviously going to be applied to the net amount after deducting. Trade discount. Trade discount. And that's what we're seeing right here. You see that less 10%, Lori?
Mhm.
You know, we're not going to put the 760 in as gross sales and call that a discount. That would be terribly misleading and wrong, and it would skew numbers. Describe and use merchandise account, purchase accounts, compute net profit, okay? So here we go. Where we had sales in the prior chapter, we have purchases. And now we have purchase returns and allowances and purchase discounts, okay? And we're going to add something, freight in. The cost of bringing that goods into your building is really part of the purchase.
Mhm.
Purchases at this point in our class are a cost. It's an expense, okay? We are debiting purchases at this point. We're not going to debit merchandise inventory until a little bit later. And the reason for that, Lori, is under this periodic method that we're teaching, when you sell the product, you only record the sale. What I mean by that, you debit accounts receivable and credit sales. But you're not recording the cost of goods sold at that point. Your system does not allow you to do it for whatever reason, perhaps a small business. So what's going to happen is at the end of the month, you're going to have to count the inventory and figure out what the cost of goods sold was. So here, and you can let me know if you can't read these.
No, they're good.
Okay, purchases, huh? That has a debit balance, just like sales had a credit balance, debit balance for purchases, and it's considered an expense, not an asset. If we return something to a seller, we're going to credit purchase returns and allowances, and debit accounts payable. Same thing, purchase discount, okay? Freight is, if we bought something for $9,500, then we got a freight bill for $500, that is an expense called freight in. That's part of your purchases. So that's a little bit something new there, okay? But so far, it's pretty much a mirror of the prior chapter. The purchases account. This is the cost of the merchandise. This is the cost of the merchandise. Unfortunately, when we sell some of this stuff, we don't have a capability of recording the cost of goods sold. So that's going to come later. And purchase account has a debit balance, and this account is credited only during the closing process. Remember, I used to threaten with the guitar, you never debit sales, you never debit sales, you never credit purchases, never. What do you credit? You credit the contra purchase accounts. So here they bought something, here they bought something for cash, debit purchases, credit cash, or debit purchases, credit accounts payable, okay? That's pretty vanilla. Purchase returns and allowances. One man's purchase return is another woman's sales return, right? It's the same thing, just depends on what side of the river you are. Contra purchases account used to record purchase returns and allowances. Notice this has a credit balance. It would have to have a credit balance since purchases have a debit balance, and these are the contras. These credit balances are going to reduce our cost. Credit for the return, credited for the amount of returns and allowances. Debited only during the closing process. I wish they didn't say that, because that leads some people to think, well, maybe you do debit it once in a while. No, only when you close it. Purchase returns and allowances. $200, we bought something, it was defective, we returned it. Well, when we return it, we no longer owe the $200, right, Lori? We had credited $200 when we bought it. So we don't owe that money anymore. We debit $200 accounts payable. And since you never credit purchases, you know now you credit the contra accounts. The account shown as a deduction from the purchase account. And just like you had net sales, we're going to have net purchases. Net purchases. There's something else I wanted to say here. I'll get back to that. Purchase returns allowances. Here's another example. Assume the same merchandise is retained, but the supplier grants a price reduction of $45 because of the defects. This is a good one here. In other words, what happened was we tried to return something. We tried to return something for $200. And in this case, the guy said, look, I don't want those $200 items back. How about I knock $45 off the cost? And you say, that's okay. I can go with that. So that's an example of, again, we don't owe $45, but the guy gave us an allowance. Returns and allowances. He gave us a break. And again, these contra purchase accounts have a credit balance. Purchase discounts. Didn't we just see the same slide before? Oh, perhaps not. Okay, I'm getting ahead of myself. Okay, purchase discounts. A contra purchase account used to record cash discounts allowed on purchases. It's credited for the discount granted by the vendor for early payment. So a purchase discount is the same 210 net 30 thing, right? As we know from chapter 10, 210 net 30, 2% 10 net 30. You get a 2% discount if you pay in 10 days. Otherwise, you pay the net in the 30, meaning the entire thing. So this is the reciprocal. And let's take a look. Merchandise purchased for $100, credit terms 210, and they paid the bill within the discount period. So here's the mirror to chapter 10. We don't owe the $100 anymore. So we debit that to get rid of it. And we settled that bill with $98, right? $2 credit to purchase discount. It's a contra cost account. Contra cost account. The opposite of this in chapter 10 would have been a debit, I guess, to accounts receivable, sales discount, and then cash. Not going too fast so far, Lori?
Nope, you're good.
I feel myself talking too quickly here. I don't know what's going on. Let me have a little snort here, okay? A little. Oh, that's good booze. My Jackie Gleason imitation.
Mhm.
Here we go. Nobody knows who Jackie Gleason is in any of our classes. You know Jackie Gleason.
Oh, sure.
There we go. Freight in. Okay, it's an adjunct purchase account used to record transportation. This is an expense. It's a cost. It's going to be part of your inventory, part of your purchases. So if you buy something for $100 and then the truck driver brings it in and charges you $10, that is a debit to freight expense and credit to cash or whatever. The account is debited for transportation charges. Let's have a little fun with FOB. Free on board. Freight on board. Free on board. Have you ever heard of this before, Lori? FOB? What do you know about this?
It's always been something that's kind of confused me.
Okay.
But it has to do with who pays the shipping and where it's coming from.
Yeah, exactly. Yeah. Let me make it as easy as I can. FOB represents the point in time where title to the goods passes from the seller to the buyer. Okay, that's all it is. At the FOB point, the buyer now owns the goods. And we're going to talk about two different points. FOB shipping point. FOB. What this means, Lori, the title changed at the point of shipment. So we have a business here on campus, and we filled up a big truck with $1 million worth of merchandise. As soon as that truck left our campus, we don't have to worry about it anymore. It's now the responsibility of the buyer. The buyer owns it at that point. The buyer must debit inventory and credit accounts payable. The buyer is responsible for paying all the freight charges, transportation charges. If that truck crashed, and nobody got hurt, by the way, in this crash, but that truck tipped over and all the goods were destroyed, that's the buyer's insurance that would take care of that. Okay. Freight charges are listed, can be listed separately or sent as a separate freight bill. We're not going to worry about that too much now. But you get the gist of that, Lori, when the title changes. That's the FOB point. And FOB shipping point is the reciprocal of FOB destination. Now, suppose that same customer ordered the goods again a month later, and the customer said, look, after the fiasco with that truck that fell over the last time, I don't want anything to do with bringing it into my own factory. So you agree to sell it FOB destination. And that truck leaves our building here on campus, and it drives across the Rocky Mountains, across the Mississippi, goes all the way to our plant in New Jersey. And half a mile before that, the truck breaks down. We're responsible for it back here in California. FOB destination. Seller pays for the transportation charges. Seller owns until delivered. And the freight charges are not going to be on the purchase invoice in this case here. This can be a very strategic thing, Lori. Shipping point destination. Companies can argue about that a little bit for different reasons. I had a job briefly after I left my one long-term job, and they had an agreement to borrow money from a bank based on the amount of receivables and inventory, called a revolving loan. Have you ever heard of that, a revolver, where the bank says, I'll give you up to so much money as long as you have this much collateral. And there were times we couldn't make the payroll. We couldn't pay people. So I would call the guy in Oklahoma and I would order a tank car of resin. And I would say, please, FOB shipping point, if you will, because that meant I could debit inventory immediately and thus borrow against that. So there's all kinds of reasons that one company would argue they want an FOB shipping point destination. The shipping point can be anywhere. It could be Chicago. We're responsible till it gets to Chicago. As soon as it passes the stockyards, well, then the buyer owns it, huh? And here's an example of freight. Merchandise was purchased for $400 plus freight. And it looks like the freight was included in the invoice as a separate line item. And we do want to recognize the freight as a separate item. So it was purchased for $400 plus freight. Purchases is debited, freight in debited, accounts payable. Not too bad, huh, Lori?
No, pretty good.
Are you taking I probably asked this a few times. Are you taking 230 next semester?
I think I am, yeah.
All right, maybe see you there. Freight example. If the freight charges are on a separate bill, in other words, we pay the freight, but sometimes the buyer, the seller pays the freight up front first, and we repay him, so it's in his bill. That's the only difference here. Here, the guy, the company that sold it to us said, you're responsible. You go out and get your own shipper. So here we go. We made the purchase on account, 400. We have the same debit to freight in, but it was just that it was from a different company. That's all. In the first example, the seller put the freight on his invoice. Here, it was a separate freight company that billed us directly. Gross profit. What's gross profit, Lori? Did we go over that much in this class?
We haven't really talked about it.
All right, very good then. Gross profit, get ready. Sales minus cost of goods sold. That's all it is. Sales, net sales minus cost of goods sold equals gross profit or gross margin. Okay. Cost of goods sold, it's the difference between what's available and the ending inventory. Let's skip that because we're not ready for that yet. But just understand gross profit. Cost of goods sold is just one specific expense. That is what we paid for the goods we sold. It's just that one expense. So companies want to know, well, if we're selling this garment for $100, what does it cost us to buy the garment? And if it was $40, the gross margin would be 60, and businesses can make decisions based on the gross margin. Every other expense after that, Lori, is called an operating expense. Advertising, salaries, utilities, insurance, rent, security guards, those are operating expenses, and they will be subtracted from gross margin to get net operating profit. Oh, wow, look at this one here. Computation of gross profit. Assume the following for the year. Well, they're looking for gross profit. How do we do it? Sales minus the returns allowances minus the discount. That'll give us net sales. Look at this, Lori. They're giving us a whole pile of stuff. I don't see cost of goods sold in there at all, right? What we're going to try to learn now is we have to take these purchases and the freight and somehow figure out what the cost of goods sold was. And it's a pretty logical process, okay? Well, we know gross profit is net sales, and we had gross sales minus the allowances. This is the price charged to customers. Compute cost of goods available. Let's just look at this one sentence, Lori, okay? Goods available for sale. I wish they'd said this thing in better English. Beginning inventory plus the cost of goods purchased gives you an amount available to sell. Think of these as units. At the beginning of the month, you had 1,000 books in your bookstore. Then you purchased 9,000 more books. You add that together, and we're going to call that goods available for sale. You could not possibly have sold more than the 10,000, right, Lori?
Mhm.
You had one in the beginning, you bought 9, you can't sell more than 10,000. So at the end of the month, we're going to look at that cost of goods available, and we're going to go out and count the inventory and subtract the ending inventory from the available. And that's our cost of goods sold. And I hope we have some good depictions here. Compute cost of goods sold. Well, we just learned that the beginning inventory plus the purchases gives us cost of goods available.
Mhm.
All we must do now is subtract the ending inventory. Of the 129,500 of merchandise available to sell, 18,000 was not sold. So we're assuming that what's not there was sold. And that's going to be our cost of goods sold on the financial statements. What's available for sale? We either sold it or we still have it in the inventory. That's what we're assuming. We're also not worrying about somebody stole things or something, okay? Gross profit equals net sales minus cost of goods sold. So here's a bit of an elongated income statement, I believe. Wow, that's really big. Okay, sales. Here we go. It looks kind of daunting at first, doesn't it, Lori? All this stuff up,
Mhm.
but the divide and conquer. Sales minus sales returns and allowances, sales discounts, minus credit cards if you had them. Net sales are 199. Net sales minus cost of goods sold equals gross profit. The trick is computing the cost of goods sold. And here we go. We had a beginning inventory of 26,000. We went out and we credited accounts payable for 105. Those are purchases. We were able to wiggle an $800 allowance from the seller for some reason, and we paid some bills within 10 days. So this reduces our purchases. You can think of that as gross purchases. Now we have net purchases. Okay, not too tough. Well, we had to pay some freight. So what do we have here? We have the beginning plus the net purchases and the freight. Cost of goods purchased. I'm not sure we need to show that, but so what's available? We started with 26. We purchased 103,500, 129,500. The month end comes, we go out and we physically count the inventory. We actually count it, and we've got $18,000 we have not sold. Therefore, we're assuming that 129 minus 18 will give us the amount we did sell at cost. At cost. And there's your gross profit. A little confused at this, Lori, here?
It's a little confusing, but doing the homework helps.
Yeah, I mean, again, divide and conquer. The net sales is pretty easy. And all we're saying is you started with so much, you
Mhm.
added to it with purchases,
Mhm.
and that total we're going to call available, and you either sold it or you did not at month end. Okay. So this page here is a key graphic to look at. Good template. The accounts payable ledger. Now we're going to go. Do you remember these with chapter 10? The accounts payable ledger. Remember we had a customer ledger. Remember
Mhm.
we had in chapter 10, the balance in accounts receivable was $100,000. And then we had a ledger, a subsidiary ledger that said, well, Joseph's company owes us 10,000. This guy owes us 20. That's what we're talking about here, except it's on the payable side. This is what we owe. So we must keep a subsidiary ledger, which has an individual account payable for each supplier and numbered. Yeah, it'll probably be numbered, filed alphabetically, summary accounts. Let's cut to the chase here. Assume the following. We purchase goods from Blinky and we purchase from Ellsworth. I'm just looking to see if anything's different here. We purchase from this guy. We purchase here. So these are all the same. These are all purchases on account. So on April 4th, our journal entries, we debit purchases, credit accounts payable. Okay, not too bad there.
Mhm.
Now we have to put these purchases into the general ledger. And they're just reviewing what the ledger's like. You put the date in, the amount of the transaction, the new balance, enter the journal page number. And then it says in the journal, enter the ledger account. Okay. So here is what we talk about. And you can read the numbers, Lori?
Mhm.
Sorry. Okay. Here we go. We purchased, they're just showing you the first two purchases. We purchased debited purchases, and that debit comes over here. There's our debit to purchases. Purchases is an expense. It's going to grow as the month goes on. It's not going to go down. Accounts payable was 3,300. There's your credit.
Sorry.
Is that you or me?
That was me. Got it.
No cell phones.
I know, sorry.
I'm going to digress briefly. When I'm in the classroom, I make a big show of turning my cell phone off in front of the whole class. Hint, hint, and suggest of course, it's hard for them. They just can't do it, these kids.
I know.
Right?
I'm sorry, I always forget to do it. And it rings on my computer.
I know. And so this was kind of funny. I came to class one day and I said, look, I have to leave my cell phone on because I'm expecting a call from the auto repair shop. So the phone rings and I noticed it was a FaceTime call. And I wasn't really paying attention. I opened it up. It was like 7 of my friends back in New Jersey at a bar down the shore. And they said, Smagol, how you doing? What are you doing? I said, I'm in the classroom. I'm a teacher, you dopes. And I showed the class. And anyway. So I don't think posting to the ledger is a problem, right? Posting to the accounts payable ledger. Well, we're going to have the same information. Enter a slash followed by a check mark. Let's see what that's about. Okay. Well, we just looked at the posting to the general ledger. We must post this as well to the subsidiary. So accounts payable, 4,800. We have to know who that customer is. And it looks to me like that's the balance. I'm sorry. 3,300 credit to accounts payable. Here it is. We're increasing the balance that we owe Belinsky or Belinky CycleWorks, 2,500. And they're giving you a few pointers here. Well, yes, we know we have to put a date in, and there's probably going to be some kind of reference number. In the QuickBooks, they assign that number automatically. At least they used to. Okay. And all it's going to mean is it's going to be the journal entries you wrote at a particular time. That's all. So this isn't too tough. We record a purchase. We record it in our general ledger with a journal entry, and we post over to this ledger. And of course, the total of these individual balances must equal what the balance is in accounts payable on the general ledger. General ledger is called the control account. They're the boss. This is the subsidiary, the detail. And you can even have subsidiaries to subsidiaries. You might have another subsidiary for Belinky where you list the types of things he bought, something like that. Subsidiaries. The auditors are going to come in. How much do you guys owe accounts payable? 10,600,000. Who do you owe it? To whom do you owe it? And you hand them this ledger and they work through that. They'll contact these people. Get some due diligence going. Posting purchase returns, huh? Sunflower return, $200. Okay, so we have to post it to the control account, which is accounts payable, and to Rand's Designs. And here we go. We return something, so that's going to reduce our cost. We don't have to pay it. We reduce accounts payable with a debit, and we bring it over to the general ledger. There's a debit there, and there's our credit. But we also must bring it over to Rand's Design. They had a balance of 5,300. After we return this merchandise, the balance is only 5,100. Cash payments. Well, this is going to be an exact reciprocal, an exact mirror of chapter 10, where we're looking at the 210 net 30 world. So here we go. Sunflower bought a couple of things. They paid Ace Wheelworks for purchases made on account. I guess there was no discount. They debit accounts payable to zero it out, and they credit cash to reduce it. Here, they paid Gunnar Cycles $8,700 less distribution of 1%. So here we go. We're going to debit accounts payable for the full 8,700. We don't owe that anymore. And we settled that bill with $8,613 in cash because we were entitled to a purchase discount. You good with that, Laura?
Mm-hmm.
Yeah, you learned chapter 10, you learned chapter 11 a little bit. 11 adds a lot more extra though. And here, I guess we should look at this, huh? Oh, here we go again. They're just showing you the posting to the ledger, accounts payable, credit. These are the credits to cash, the debit to accounts payable, and here you see it over here. We had a balance with Ace 4,800. We paid them. We paid this guy. Not too tough a chapter.
Not too bad.
Schedule of accounts payable. Remember the subsidiary? This is just a list of the balances in the subsidiary schedule. It's prepared to verify that the sum of the accounts payable ledger equals the control account accounts payable.
Mm-hmm.
And they're saying alphabetical, numerical, probably alphabetical. You do it at the end of the month. You can do it anytime you want, but you have to do it at the end of the month. And the total calculated in the schedule is compared with the balance in accounts payable. So here we go. Belinsky or Belinky. I have a feeling there's an S missing from that name. because there was a pitcher, Bo Belinsky from New Jersey. You never heard of Bo Belinsky, huh? Anyway. I keep saying Belinsky, cycle word. 3,300 is the balance on this guy, Ellsworth, Milwaukee Cycle, Rands. So at the end of the month, we owe $11,900. 11,900. And here is that balance here. 11,900. Everything's in order, huh?
Mm-hmm.
Schedule of accounts payable. I'm not going to really go over this. We did this a little bit in finding errors, verify the totals, verify, finding accounts payable errors. There's only once you know what the mistake is, Lori, there's really only one way to do the correcting, and that is to reverse the original entry and then write the correct entry there. Okay. Don't take a shortcut where you say, well, the cash is right, but I debited it to accounts payable and should have been something else. Reverse the entry and then do it right.
Okay.
And that's about it. We're not going with the net price method of recording purchases. So this chapter here is pretty much a reciprocal with the computation of the gross profit and cost of goods sold,
Mhm.
the kicker. So this is really the new part here. And again, it's pretty intuitive, I think. Beginning inventory plus whatever you purchased on top of that is the available for sale.
Mhm.
You either sold it or you didn't. Under this method here, which we're working with now, Lori, called the periodic method, obviously we don't record the cost of goods sold, like we said, till the end of the month. Now, in future chapters, like the last 3 chapters of the book, we're going to be working with a perpetual inventory system. And I bet you're familiar with that. A perpetual inventory system, you're recording both the sale and the cost of sales at the point of the sale.
Mhm.
So theoretically, you know every second of every day how much is left in your inventory
Right.
and what your cost has been. You call a small mom and pop shop and you ask them if they have a couple of cuckoo clocks you want to buy. They may not know off the top of their head. They're going to have to run in the back and look. You call a big store like Costco and you say, do you have these 3 TV sets available? Whammo, one click of the screen and they can tell you exactly. So, all right.
All
I guess
right.
that was a pretty easy, no, I wouldn't say easy, but a smooth class.
Yeah, pretty straightforward.
Any questions on anything?
I don't
Anything?
think so. I think we're good.
All right. What's in the oven today?
I'm taking a break today.
Oh, okay. All right. Well, you enjoy your respite from the oven and we'll see you a week from today. Okay.
Sounds good.
Hey,
All
good
right.
night.
Have a good day.
Bye-bye.
Bye.